Good morning, everyone, and welcome to another Friday Financial Review. I'm Paul Griffiths, Financial Planner for Europe. So, we're now into July. Yes, it's July, the other side of the year and getting closer to Christmas. Please don't hate me for it. So, today will be the third part to our taxation on those resident in Portugal. Obviously, I interrupted the Portuguese series last Friday to bring you speculative news about the UK autumn budget and how it affects the worlds of pensions. Today, I guess, links in quite nicely to the subject of pension because we're going to be talking about taxes on pension. You're living in Portugal. Let's dive right in. NHR. Many of you will be on the non-habitual residence regime. What does that actually mean? When it comes to pension, if you were granted your NHR status pre-March 2020, then it means that Portugal will not tax you a single penny on your pension income. Of course, that doesn't mean you avoid paying taxes because in some countries your pension may be taxed at source, okay? And then you can try to reclaim it back, of course, because you're no longer resident in that country. But certainly the pre-March 2020 NHR holders, no taxes to pay on your pension for the 10 years of that status. So, happy days. For those who were granted NHR more recently, the tax on pension income is at a flat rate of 10%. This came out because a lot of the other EU member nations complained why Portugal was doing this status, almost turning it into a tax haven of sorts. And as a result, Portugal simply imposed a flat rate tax of 10% for pension income. Still very advantageous, very, very good. So many of you will be watching this and thinking, well, you know, Paul, I'm here normally. I have no NHR status. We don't qualify for it. What about us? Simply put, in Portugal, like most countries, you're going to have a nil rate band, a personal tax allowance. In Portugal, unfortunately, is not as favourable as some other countries. I believe it's just a tad over €4,000 you can receive in income before taxation occurs. Pension income then simply gets taxed at the progressive rate of tax, like normal income. So it's going to start from 14.5, and then depending how much each year, it goes all the way up to just below 50%. So yes, pension income is pension income. There's no real way to get around it. You choose a country you live in. But of course, look, most of us is going to pay a median average of between maybe 20 to 30% if you're having a good, level of income coming in. Okay. Now this simply just covers what I call private pensions, company pensions, so basically your non-government pensions, okay? For those of you who have worked for the MOD, other civil service department, and potentially local authorities as well, you'll find that, forget about the NHR, you'll find that Portugal will not have taxation rights on those pensions. So you simply pay those taxes, i.e. in the UK where you came from or where you have the pension from. For those living on the state pension, well, as you know, the state pension actually is not a pension, it's a social benefit. So again, there's no taxation rights there from Portugal. It's purely taxation rights from the source country, so the UK in this particular case. But of course, all these pensions, even though they're only taxed at source in the UK, for example, they do, however, go on your return because they use up your allowances, and if you have other income coming in, private pensions, company pensions, it simply gets added to the top and you pay your progressive rate of tax for those no longer on NHR. Okay? So in this series altogether, my part 1, part 2, part 3, we've looked at Portugal on a top-down, very broad look. What I feel is very important for everyone to understand here is, despite the taxes in each country, because you will pay tax, is one of the two things that will happen to you. You pay tax and you die, okay? It's about managing and planning how you're going to fund your retirement, in what way is the most efficient way, okay? And certainly with the recent news and speculation from the Chancellor looking to reduce pensions lifetime allowance, looking to put in a flat rate of tax relief on pension contributions, it's even more important that you start early. Start early, plan your future. If you're 20, 30, start early. Those in their 40s, 50s, 60s, you need to make sure whatever you've accumulated is planned properly. Put your ducks in a row. If your ducks are not in a row, you're only going to do yourself harm in the future. So, I just want to say thank you to everyone who's listening and watching. Thank you to all my followers on my various media platforms, YouTube, Facebook, LinkedIn. Do continue to follow. Please comment, give me suggestions on what type of videos you want me to do next. Share my videos with your friends, your colleagues, especially if you know somebody is planning to leave the UK and they're wanting to come to Europe. I can't stress how important this is. If you know you're going to leave, you're better off planning before you come to the UK. Okay? So, thank you everybody. Have a wonderful Friday, of course. I will be off to the beach bar. Not now, of course, it's too early, but I'll be off to the beach bar later on this afternoon. And getting my hair cut on the weekend. So, yeah, whatever you're doing, have fun, stay safe, and I'll see you all next week. Bye now.